So, you're thinking about investing in real estate, but you keep running into this wall of jargon, a dizzying array of metrics and acronyms. Well, today, we're going to cut right through all that complexity. We are going to break down the essential numbers you absolutely need to know so that you can walk into any deal and evaluate it with total confidence. Let's dive in. And you know what? We're not alone in feeling a little lost sometimes. This question right here, I love this. It was pulled straight from a Reddit forum for actual commercial real estate pros. It just perfectly captures the feeling, right? There are a lot of smart, motivated people out there who feel overwhelmed. And this confusion, this is exactly where our journey begins today. We're going from this very real question to total clarity. Because let's be real, this is what it feels like when you first start. It's just an alphabet soup of metrics. You've got cap rate, NOI, ROI, IRR, cash on cash. It's so easy to get them mixed up, or even worse, to use the wrong tool for the job when you're making a huge decision. But don't you worry. By the end of this, you're going to see how all these pieces fit together like a puzzle, and we are going to bring some serious order to this chaos. All right, so here's our game plan. First, we'll tackle the basic dilemma every investor faces. Then, we're going to build our foundation with the single most important number of them all, net operating income, or NOI. From there, we'll decode the most famous, and yeah, the most misunderstood metric, the cap rate. Then comes the really fun part. We'll introduce the game changer, leverage. And finally, we'll put it all together into your complete toolkit for analyzing any deal that comes your way. So let's kick things off with the investor's dilemma. You're looking at a property, right? You've got a price, you've got rent rolls, you've got a list of expenses. How do you possibly find the signal in all of that noise? How can you compare one property in one part of town to a totally different one across the state in a true apples-to-apples way? The goal here isn't just to memorize definitions, it's to give you a step-by-step process for breaking down any deal methodically. Everything, and I really do mean everything, starts right here with net operating income, or NOI. I want you to think of this as the pure, raw profit that a property generates all by itself. It's the money that's left over after you've paid every single bill required to keep the building running smoothly. But, and this is key, before you've paid your mortgage. This is the absolute bedrock of your analysis. And that leads us right into our first big idea, looking at NOI as the property's profit engine. We have to master this before anything else makes sense. Why? Because NOI tells you how good the building is at making money, completely separate from how you, the investor, decide to pay for it. It is the financial heartbeat of the asset itself. Okay, let's make this super concrete with a simple example. So, we start with all the money the property brings in. That's rental income, maybe some parking fees, laundry, whatever. For a gross revenue of $125,000. Then you subtract what it costs to run the place, your operating expenses. Things like property taxes, insurance, repairs, management fees. In our example, that's $35 grand. What's left over? That $90,000, that's your net operating income. Now, this next part is so important. I want you to pay close attention to what is not in that calculation. Your mortgage payment is not there. Big, one-time capital expenditures, like putting on a whole new roof, are not there. And your personal income taxes are not there. And that's exactly what makes NOI so powerful. It lets you judge the property on its own merits, completely isolated from your financing decisions. It's the only way to get a true apples-to-apples comparison. Okay, you with me? Because once you've got your NOI locked down, you can calculate the most famous, and honestly the most misused metric in all of real estate, the capitalization rate, or as everyone calls it, the cap rate. You know, if you go back to that Reddit thread, you'll see a dozen different people arguing about what this number actually is. So here's the first take you'll always hear. Someone on Reddit says the cap rate is your return on investment, your ROI, if you bought the property with all cash. And you know what? That's a great way to start thinking about it. It's simple. It connects that pure profit, the NOI, directly to the price of the property. Makes sense. But just when you think you've got it, someone else chimes in with this. They say, no, cap rates are about risk. The higher the cap rate, the riskier the deal. And that makes sense, too, right? Think about it. A property in a super safe, prime neighborhood is going to have a low cap rate, while a property in a more up-and-coming area is going to need to offer a higher potential return, a higher cap rate to compensate you for taking on more risk. Okay, so now it's a risk meter. And then, just to make things really interesting, a third person comes along and compares it to the stock market. They say a cap rate is basically just the real estate version of a PE ratio. A 5% cap rate means the property is valued at 20 times its annual earnings. A 10% cap rate means it's valued at 10 times its earnings. That's a brilliant way to look at it as a valuation tool. So what is it? A return, a risk indicator, a valuation multiple?
Well, the truth is, it's all of them. That's what makes it so powerful. The formula is beautifully simple. It's just your net operating income divided by the property's price. So it is the return you'd get if you paid cash. And because of market forces, it does reflect the perceived risk. And because of the math, it absolutely is a valuation shortcut. It's a simple little number that tells you a whole lot about a property.
But here's the thing. Up until now, we've been living in a fantasy world where everybody pays for billion-dollar buildings with cash. The very second we introduce a loan from a bank, what we call leverage, the entire game changes. Debt completely transforms your returns, and that means our trusty cap rate, well, it's just not the whole story anymore. We need a new set of tools.
And this right here, this slide, is the big aha moment for so many investors. You have to start thinking about your metrics in two different buckets, unlevered and levered. Unlevered metrics, like our friend the cap rate, are all about the property itself, in a vacuum, with no debt. Levered metrics, on the other hand, are all about you, the investor. They measure the return on the actual cash that came out of your pocket. So let's meet the stars of the levered metrics show. First up is cash-on-cash return. Honestly, this is the number most investors are obsessed with, and for good reason. It asks a very simple, very personal question. For every dollar of my own money that I put into this deal, how many cents do I get back in my pocket this year? Then you have return on investment, or ROI, which is a bit of a broader term that often looks at the total profit you're making, including the equity you're building up over time. Let's go back to our example property, the one with the $90,000 NOI. Let's say we buy it for a cool $1 million, all cash. Our initial cash invested is the full $1 million. Since we don't have a loan, our debt service, our mortgage payment, is zero. So our annual cash flow is just the raw NOI, $90,000. In this super simple case, our cash-on-cash return, our ROI, and our cap rate, they are all identical, 9%. See? Simple. But now, watch the magic happen. Let's introduce leverage. We buy the exact same property for the exact same $1 million price. But this time, we only put down 20%, just $200,000 of our own money. The bank covers the rest. Our NOI is still $90,000, that doesn't change. But now we have to pay the bank. Let's say our mortgage is $50,000 a year. That leaves us with $40,000 in cash flow. But here's the key. We divide that $40,000 by our actual cash invested, that $200,000. And our cash-on-cash return is 20%. Just let that sink in for a second. We went from 9% to 20%. The property didn't change, the tenants didn't change, the rent didn't change. The only thing that changed is that we used other people's money, leverage, to dramatically amplify our returns. This is why you have to know the difference between unlevered and levered metrics. It's everything. Okay, so now we can finally assemble our complete toolkit. You see, the goal isn't to find the one best metric. That's the wrong way to think about it. The goal is to know which tool to pull out of the box for which specific job. They don't compete with each other. They all work together to paint a full, rich picture of an investment opportunity. Before we lay it all out, let's add one more, slightly more advanced tool to our belt, the internal rate of return, or IRR. It's built on a really simple idea. Would you rather have $1,000 today or $1,000 10 years from now? Today, obviously. A dollar today is worth more than a dollar tomorrow. That's the time value of money. And IRR is the metric that gets that. While cash on cash is just a snapshot of 1 year, IRR looks at the entire lifespan of the investment, all your annual cash flows plus the big payday when you sell, and it spits out a single annualized rate of return. It's the pros metric for total performance. And here it is, your complete toolkit. You can see it all laid out here. You'll use NOI to check the fundamental health of the property. You'll use cap rate for quick back-of-the-napkin comparisons to see what the market is paying. Cash on cash is all about what's coming into your pocket this year. And for that big picture, long-term view of your total return, you're going to lean on ROI and especially IRR. And look at the limitations column. It's just as important. For example, if your goal is to buy and hold for 30 years, IRI is your North Star. If your goal is to generate cash right now to quit your job, cash on cash is king. It's all about matching the metric to your personal goals. All right, so now that you've got the tools, let's quickly talk about how not to misuse them. Here are 3 huge mistakes that new investors make all the time. Number 1, garbage in, garbage out. If you're too optimistic about your expenses, your NOI will be inflated and every single one of your other numbers will be a lie. Number 2, don't ever confuse cap rate with a total long-term yield or IRR. They are not the same thing. And number 3, be really careful with mixed-use properties. A lease with a huge national company like Starbucks is way lower risk than a lease with a local mom-and-pop shop, and you have to value those 2 income streams differently. And all of this brings us to our final and maybe most important question. We've defined the metrics, we've shown you how to calculate them, but the one thing we can't do is tell you what makes a good investment. That part, that's on you. Are you hunting for stable, low-risk cash flow from a low cap rate property? Or are you chasing those high-leverage 20% plus cash-on-cash returns, and you're willing to accept more risk to get there? Now that you have the tools to actually understand the numbers, you can finally start to answer that question for yourself. You can build a strategy that is right for you.